Stocks versus Forex. What are they and key differences explained ###. Have you ever seen an investment app ad? It's a rhetorical question. I know you've probably seen it more than once on more than one website. It's normal these days. Investing is becoming more common every day, and we usually see two types of investors: Forex investors and stock investors. What is Forex investing, and what are stocks? What are the main differences, and which should you choose? In this video, I'll give you all the information you need, not just to understand what Forex and stocks are, but also to have the basic knowledge that will give you a better understanding of which you should choose for your next investment. First, I'll explain what stocks are and how investing in them works. Stocks are very simple to understand, but many brokers and institutions always complicate the subject to make people work with them. While working with a broker can be positive, knowing the basics is fundamental for healthy investing. A stock or share is fundamentally a part of a company that you can purchase to help the company raise the necessary funds for investment. As soon as you buy a percentage of the company, you are the owner of that part of the company, and you have the right to receive the equivalent percentage of what you invested when the company makes a profit. Still not clear? Let's use an example to simplify things. Imagine Frank started his business. He's always wanted to sell shoes. He's a master at creating wonderful luxury shoes and wants to build his business on his skills. To start his business, he needs $1 million. This money will be used to hire staff, pay taxes, create and customize his store, and finance his business. But there's a problem. Frank only has $100,000 to invest in his business. So, what should he do? He makes his company public, telling potential investors how good his company will be and trying to convince them of his idea and vision. If the investors believe in his business and that it has a fair chance of making a profit, they invest in Frank's business in the hope of a financial return when the company succeeds. Let's pretend Frank convinces 9 of his friends to invest in his company, and you are one of these investors. Each of them invests $100,000, helping Frank reach the necessary funds to start his business. According to simple math, $100,000 equals 10 out of $1 million, so since each person invested 10, each person owns 10 of that company. Now Frank has $1 million to start his business. And so he does. He calls it the coolest shoes around, bro. He starts producing his first shoes, sells them, then hires more and more people to help him produce and sell more, and this continues to happen until a year has passed since the founding of Cool Issues Around Bro, and the company is worth $10 million. So, you own 10 of the company, so now you have $1 million, the equivalent of 10 out of 10 million, the current value of the entire company. Additionally, every other investor has $1 million, and this is simple. Obviously, this is an absurd example with absurd numbers, but you get the point. So, when you invest in stocks, you look for companies that have potential and you believe will grow in the future. In this example, I described the case of buy to hold, which means you buy stocks with the intention of holding them for a long period. But this is not the only way to invest in stocks, so keep watching. There is also speculation, which is used in Forex trading. Speculation involves buying stocks when they are undervalued, waiting for the price to rise, and then selling the stocks to make a profit. For example, you might buy a stock that is worth $10 today and sell it tomorrow when it is worth $15, making a profit of $5. So, having said that, you should know that investing is incredibly risky. No calculation can predict the future with certainty. No one knows for sure if the stock will go up or down, no matter how qualified and experienced they are. So, you might lose a lot of money, but you can reduce that risk if you only take calculated risks. Stock prices fluctuate up and down very quickly, and the market can change drastically in a few seconds. Warren Buffett is one of the greatest investors of our time, and his advice is to always invest in companies that have potential and to think long-term. So, calculated risk is the key to good investing. Now that you know how the stock market works, let's talk about Forex. How does Forex trading work? Forex trading is quite similar to stock trading with speculation, so you buy low and sell high. The first fundamental difference is that you are not buying and selling ownership of a part of a company, you are actually trading currencies. Just like stocks, the value of currencies goes up and down every single day. For example, the value of €1 is currently 1.14 US dollars, which means the exchange rate of the euro to the US dollar is 1.14. When you invest in currencies, you are essentially converting your money into another currency, in this case, the euro. You predict that the euro will increase in value compared to the dollar, and you are right. Later that day, the euro rises to 1.15, and being in profit, you decide to close the transaction and convert your money back into US dollars, having more than you had before. However, if your prediction is wrong and the euro falls compared to the dollar, you will lose your money and will not be able to close the transaction until you either make a profit again or lose all your money. Now, Forex is actually harder to predict, making Forex or FX trading more risky than the stock market. A currency can gain or lose value very quickly, and there are advanced ways to increase profit but also risk, which we will not cover in this video. However, if you understand this basic principle of Forex investing, you are already a step ahead of most people. Forex is widely advertised, so it is very common for new investors to start with this type of investment. I have even received direct messages on Instagram from people trying to convince me to invest with them, so this is also a common practice. So now you know how foreign currency investments and stock investments work. Now let's talk about the main differences that will help you choose between one or the other. Regulation. The first difference is regulation. On one hand, the stock market is heavily regulated by institutions like the SEC, Securities and Exchange Commission. Everything is controlled by these institutions, so it is fair to say that it is a bit harder to be scammed if you invest in stocks. However, the risk of losing money is still there if you make wrong decisions. On the other hand, Forex trading is not as regulated. In fact, there is not much regulation at all, except for the BIS, which is basically the bank of all banks. However, the regulations are very flexible, so there is a greater risk of being scammed by those insta traders. Forex is called OTC, over-the-counter, trading. It is also called off-exchange trading. This means that the trading is done directly between the two parties without supervision, so a stock exchange opposes Forex because it is more transparent and regulated. Short-term and long-term investment. Another key difference is the time required to make a decent profit with a trade. Forex is bought and sold daily, so you buy it today and sell it later, or you buy it today and wait a few days or a few weeks. In some rare cases, even 3 or 6 months. However, it doesn't make sense to hold a trade for too long. Do you agree with me so far? Now, stocks are usually profitable when they are intended for long-term investments. This means you buy stocks today and wait for the market or the business to develop. You can also hold some stocks for a decade and then sell them and make millions. So, at first glance, you would say that Forex is better because you can make more money faster, but this is only if things go really well, as I said before. It depends on whether you make the right decision or not. Market purpose. The market purpose of stocks is actually usually different from what I explained before. Many people actually put their money in the bank, and from there, they invest in things like mutual funds. It is a small investment that produces very little profit. However, many people do this, and this is a huge factor when it comes to making decisions. Additionally, the stock market is very value-oriented, so when you actually invest to hold a stock or to speculate, you take into consideration the value of the company you are investing in, trying to understand if it will be successful or not. On the other hand, the purpose of Forex is basically limited to speculation. That's all. You shouldn't hold these trades long-term. You just buy, wait for the value to increase, and close the transaction. It is very simple. So, consider these very important factors when choosing between the Forex market and the stock market. What do you think? Will you start investing soon? If so, do you prefer to invest in stocks or trade currencies? Also, if there is someone who has experience, share your knowledge in the comments below. Who knows, you might help someone profit from their next investment. What was your experience with the topic covered in this video? Tell us about it in the comments, we are curious to know. And if you have any doubts or questions, don't hold back. Leave a comment, even just a simple like would be perfect, but most importantly, subscribe to the channel to stay informed about upcoming releases.